The COVID-19 pandemic, no doubt, is the biggest challenge this generation has had to face. Across every sector of the economy, businesses, including financial institutions, have suffered major hits, especially for a year that started on a very great footing for a number of Nigerian banks. Now, as the economic fallout spreads, the financial sector, specifically banks, find themselves juggling priorities that require concrete steps to reposition now while also recalibrating for the future. Banks still have to keep their service channels open with the realities of this time, such as remote working, maintaining social distancing, and advised guidelines while adhering to supervisory and compliance functions, which were hitherto not designed for remote work. Analysts have said Nigeria's economy could be headed for a recession by the end of this year on the back of the massive decline in crude oil prices caused by the coronavirus pandemic. The economy has remained very weak since exiting recession in 2017. The growth rate has only been around 2%. Nigeria's over-dependence on oil for its revenue and foreign exchange earnings continue to weaken the fiscal capacity, just as the high rate of unemployment, infrastructure deficit, poor power supply amongst problems have increased vulnerability to external shock. Managing editor, ProShare Nigeria Limited, Teslim Shitabe, joins me now via Skype from Lagos Island for more on this discussion. And later on the show, we'll bring in a macroeconomic research analyst at United Capital, Yinka Ademuwagun. That will be later also via Skype as well. But let me start with Mr. Shitabe. Thank you very much for your time, Mr. Shitabe.
Thank you very much for inviting me.
In your opinion, what are the business realities and trends of the financial and banking sector at this time?
Okay, fantastic. Well, first and foremost, we must realize that there's a great global reset. There are institutional resets, and there are also sectorial resets. So banking, just like any other sector, is prepared for a reset. Now, as you have rightly pointed out, the Nigerian economy is facing severe headwinds. Now, these headwinds are in the areas of fiscal revenue, they're in the areas of our foreign exchange market, and they're also in the area of monetary policy. And all these areas will adversely affect the financial banking and banking system. But to what extent will depend on a lot of factors. One of the major factors will be how banks respond to the new realities that we are currently witnessing. You've already talked about oil prices likely to remain low for the better part of the year. That's very true. Nigeria's break-even oil price has to be somewhere within the region of $144 per barrel. That is not likely to happen this year. Furthermore, the fiscal revenues are likely to decline. We expect a situation where you have VAT, accruable revenues from VAT, declining to 2 trillion naira from 2.1 trillion naira. We expect federation accounts to reduce from the former projection of 8.6 trillion naira to about 3.9 trillion naira. Now, all this seems to suggest hard times. Perhaps that is true. However, are there opportunities? And that's what I look at. The opportunities, certainly there are opportunities. They are what you could call tailwinds. What I've just described earlier were the headwinds, the difficulties, but there are opportunities to grow, including the banking sector. What it means is that the banking sector has to rethink the whole business of banking. You've mentioned before, the digital platforms that the banks have. Now is a great opportunity for them to see how they can leverage digital realities, AI, artificial intelligence, and other platforms that are non-physical, non-one-on-one transactions that will grow banking business as a digital experience rather than as a physical experience. And the more banks do this, the better their business will grow. More importantly, also, the pork, what I call the pork barrel, is likely to disappear. The pork barrel being that a lot of banks have very fancy offices, very heavy investments in fixed capital. That is likely to go. You're going to see more investments in research and development, in the area of technology, in the area of user experience and user interface. What do I mean by that? Banks are going to look for alternative forms of engaging with consumers. And we're going to see more use of the telephone. We're going to see more use of the laptops. We're going to see more use generally of digital platforms. And that's quite good. That means we're heading in the right direction. Because in any case, even if there wasn't a COVID, that was the direction banks had already started to move into in the first place. What COVID has done is to accelerate what they had already started. So I think, in short, that we are moving in the right direction in terms of digitalization of the banking environment. Don't forget, beyond banks, there are also other actors in the financial services system. We're seeing fintechs making payments solutions that people engage in. We see, what do they call them now? We see other banking platforms that see how they can introduce banking services to the rural areas without physical presence. Agency banking, that's it. Agency banking. We're seeing a lot more development in the areas of agency banking. That's progressive. That's really progressive, you know. So I don't think we should just emphasize the gloom that we see ourselves in presently. There should also be the benefits of recalibrating our operations as banks, as financial institutions, and even as customers of banks.
Let's now see how do you emphasize these realities that you've identified and trends that you've highlighted. How will it impact on the bottom line?
Right, good question. Banks are likely to see a slowdown in gross earnings in the year 2020. Most of that is going to be as a result of generally tailing off of growth in the national economy. The national economy is expected to decline by about 3.4% year end. That's by some estimates. Some people see it as about minus 3.5%, but that's neither here nor there. The truth of the matter is that the economy will begin to shrink a bit. Now, if the economy shrinks, banking sector activities will also shrink with it. Those transactions that the banks will normally expect to see will not be there. Perhaps worse will be a situation where I see non-performing loans also increasing. There'll be a general movement towards greater provisions for impairments. What I mean by that is that banks are going to increasingly have to make provisions for loans that will go bad. Can they avoid it? No, they can't. Unfortunately, they're going to have to just deal with it. The non-performing loans will increase, and therefore what they're going to need to do is to provide creative solutions to managing those loans in a manner that does not adversely affect their balance sheets and their profit and loss accounts too badly. So there will be a slight decline in gross earnings, but will that translate into a decline in profitability? Not for all the banks. Some of the banks are already taking proactive steps in trimming down. We heard one bank say that it was trimming down, then reversed its position on that and said, no, it wasn't trimming down. That's neither here nor there also, because the truth of the matter is that the business case suggests that banks need to get leaner, meaner, and a lot more focused on where they're going rather than where they're coming from. So where they're going is digitalization of the banking process, digitalization of their interface with their customers. Now, once they are able to do that properly, over time, average fixed costs and retail costs will start going down. The more retail customers they can get on board, the lower the average cost of servicing these retail customers. So going forward, costs will continue to go down for the banks. But immediately, the hard truth is that they're likely to see a slight diminution, that's reduction in their earnings. And when I'm saying earnings, I'm talking about gross earnings as the total earnings, as well as the earnings after adjusting for operating costs and some other expenses that are typical to these banks.
Now, what direction should businesses, particularly financial institutions, be looking at to take advantage of the new challenges and opportunities created by COVID-19 vis-a-vis their human capital and their business operation model? Will the sector go more digital than physical? You're almost saying that's what will happen.
Yes, that's precisely what is going to happen. The truth of the matter is that banking has been commoditized. It's a commodity, right? And in situations of commodities, what you see is that you're going to start seeing pressure on costs, okay? They're going to try to push down costs, and as they're pushing down costs, revenues will grow slowly, but because costs have been able to be contained more effectively, margins are either going to stay constant or they're going to rise. Now, different banks will have different opportunities. based on current structure, because all the banks are not the same. They're not the same creatures. Some banks have some competitive advantage in technology. For instance, some banks already have what I call a technology foundry, and they have sandboxes. I don't want to go too technical, but all these are technology aspects of their operations that allow them provide customized services to individual customers at barest minimal costs. Okay? Now, that means that I don't need a front office person. There's a particular bank, it doesn't have front office persons. What it has is AI, artificial intelligence. So if you have a problem, you talk to AI, AI processes it, sends it to the necessary officer who provides a solution, and the AI conveys that solution to the customer. Don't forget, AI doesn't take a holiday. AI doesn't suffer COVID. AI doesn't need to take a leak. AI doesn't need to take lunch. AI is permanently there to resolve problems. And so the customers can continuously have an engagement with the bank's AI and find solutions. Because ultimately, that's what the bank is supposed to do, provide solutions. It's a solution provider, right? So for me, going forward, they've got to be able to dimension the kind of markets they want to get into. You don't want to be all things to all people, because ultimately it means you're really nothing. But if you can provide customized services, make each customer seem special because you understand that customer's needs and you feed into that need and provide the kind of service that that customer wants at minimal costs and at top Naira quality, you're going to get ahead regardless of what the environment says, because we're going to still keep our money somewhere, aren't we? We're going to save money, and people are going to still invest regardless of what is happening. I mean, you have industries like pharmaceutical industry. The pharmaceutical industry, the medical industry is likely to expand, and they will need capital to do that, short-term and long-term capital to be able to expand. You're going to see other sectors also tweaking their operations and looking for bank support. So those sectors will also expand. However, it won't be about one-on-one human contact. It will be about us being able to upload data, analyze data, and based on our analysis of data, provide customized service for each of our individual customers. Okay? What I'm saying basically is that the shape of things to come is going to be based on a digital platform that is progressive. It preempts the need of the customer. That digital platform will have to be able to profile each customer and provide solutions even before the customer realizes that he or she has a problem in the first place. Is it possible? Certainly.
Indeed. Now, let's look at the sort of quality and now of human assets that banks should retain or acquire. Will jobs be created or lost in all of this?
You know, I've heard this question. I've been asked this question severally. And the way I want to look at it is like this. Rather than us worrying about what jobs are created, what jobs are lost, I would want us to concentrate on what value is created. Okay? Now, the value propositions is what is going to drive the economy. The value propositions is going to drive what kind of worker I need. For instance, I've already told you that the banks are generally going to migrate onto a greater amount of digital technology. And that means that there's going to be less one-on-one human contact and interface. So what does that mean? Does it mean that some people will lose their jobs? Certainly. Does it mean that some people will actually be employed? Certainly. Now, what is important is not whether people lose jobs or whether they're gaining jobs. What is important is what value comes into the system. Because if you provide the right value, you will get the right job. It's simple and difficult at the same time. It's simple in the sense that you need to have the right skill sets for the future market. And it's difficult because people have already been locked into the old economy. Yeah, let me call it the old economy system, whereby it's about I meet you face to face. Now, if a person has skill sets in the area of big data, you have big data skill sets, you have artificial intelligence skill sets, which means that you can code, that you're a very good you're a good coder. So if you have skill sets in the area of user interface and user experience, whereby you can design a feel about the technology that banks deploy, you'll definitely be valuable in the banking space. But there's one thing I need to say: moving into the digital era is inevitable. There are no two ways about it. And to understand this, we've got to migrate our educational system into a framework that looks at tomorrow's emerging business growth areas. What are the touch points of growth of the Nigerian economy going forward? We cannot go forward while our heads are buried facing the past. COVID-19 has clearly shown that there will be shocks. These shocks are shocks we can't prepare for. But what we can prepare for is our vision of the future. Now, if we have a vision of a future, which some banks had actually, of a digital future, then most of these banks who have had this vision have been better able to cope with the realities of a COVID-19 situation. Because one particular bank had already developed an AI that had been tested and had won awards globally for its effectiveness. So you can imagine, currently that bank will be smelling like roses because it already has that infrastructure in place. So banks have to be forward-looking. Workers, now this is where it is. Workers have to be forward-looking. Now, if you're going to school and you're saying, okay, I'm going to study, then you've got to look at the end game. What am I going to study? How does what I'm studying go to create value in the Nigerian system? Not today, but tomorrow. Would the Nigerian system of tomorrow require this kind of skill sets? Because if you're looking at yesterday's skill sets, most of those skill sets will disappear in terms of need. I'm not saying totally or be obliterated, but they will gradually shrink in significance relative to other skill sets. So the skill sets people acquire today must be relevant for the economy of tomorrow. Are banks going to see a slight reduction in jobs? Yes. Are they going to see an increase in jobs? Also, yes, because there will be job losses in some areas and there will be job creation in other areas.
Before I let you go, Mr. Shitabe, as financial institutions plan now for full-scale business operations, what are the economic pathways or what economic pathways can be explored for growth? Now, should they be looking at streamlining operations at this time? Or what should they be do to stay on course for the future as market forces and customer behaviors change? We all know that will definitely change.
Yes. Very easy. First and foremost, the place to start is not really cost cutting. That's the easy way out and may not necessarily be the most effective. It's not what I mean when I say cost cutting. Yes, certain areas, pork barrel will have to be reduced. The fat will have to be reduced. But that isn't it. What is it is to look at the Nigerian economy, dimension it, see where the opportunities are, and provide solutions that meet the needs of those emerging opportunities. Now, I'll give you, like I said before, some industries will expand and grow slowly. Some industries will expand and grow faster in the short term. Some will grow faster in the medium term. And some you're going to have to wait a long time, which means that those industries where you have to wait a long time, you've got to be able to say, do I have long-term capital solutions to meet their needs? Those that will grow in the medium term, do I have money that is of a medium-term nature to finance that need? Now, those with the short term, which are in the majority, because Nigeria basically does internally, it's about trading and commerce rather than manufacturing. So those short-term needs, do I have the kind of funds for those to meet those short-term expectations? Can I generate long-term funds that I can roll over consistently to be able to fund short-term transactions so I don't have a mismatch, a funds mismatch? Now, all those things are going to come into play. Your business model as a bank, you've got to do a lot of scenario planning. You've got to ask yourself, look, COVID is here. Is the COVID going to be short-term, which is 3 months, which we have already gone past, or is it going to be 12 months? Now, in that period of time, am I going to see a fall in oil prices or a gradual stabilization of oil prices or a gradual rise in oil prices? Is the fiscal authority going to have to take a lot more domestic lending through the capital market? Or is the fiscal authority going to opt to say, okay, you know what, I don't want to overburden the domestic money market or capital market, and therefore I'm going abroad. You've got to dimension all these things. These are primary scenarios that need to be agreed first. Yeah. So once we've done that and settled on a most likely scenario, then we can go ahead and say, okay, fine, based on this scenario, what kind of revenues am I likely to generate? Where are those revenues going to come from? Like I've said before, you've got pharmaceuticals, you've got the medical sector, you've got agriculture, which is also going to come up into its own over the period. And you can say, okay, solid minerals. There's also that sector that's going to come up. There are other sectors that are going to come up that perhaps we haven't seen them now, but they will start nudging their presence in the near future. And we'll say, okay, how do we feed into this? My primary concern here is not the cost, because the cost.
Yeah, 30 seconds. 30 seconds. Round it up.
Okay. So yes, cost is important, it's significant, but it isn't the total story. We have to look at the opportunities and grow along the opportunity curve rather than just keeping our eyes buried on the cost.
Mr. Teslim Shitabe, very nice talking to you. He's the managing editor, ProShare Nigeria Limited. Thank you very much. I believe there's going to be a part 2 of this discussion. We need